Hello. Let's look at a practical application of FIFO, LIFO, and what I'm going to refer to as moving weighted average inventory cost flow assumptions. So let's do an example here. Assume that XYZ is a wholesale distributor. The following represents or reflects inventory transactions for the month of May in the current year. In other words, he has a beginning balance, and then during the month of May, beginning balance at the beginning of May, and then during the month of May, he purchases some cases and he's selling cases. And ultimately, we're going to ask ourselves to calculate the amount of total cost of goods sold for the entire month and the remaining ending balance of inventory at the end of that month. But we're going to do it under the three different scenarios, whether we're going to use a FIFO inventory cost flow assumption, or whether we're going to assume that it's on a LIFO basis, or using this moving weighted average approach. Let's begin by looking at and analyzing these transactions under an assumption of FIFO, first in, first out. Now, the way I'm going to approach this is I'm going to actually create a general ledger T account for inventory and for cost of goods sold. The reason why I'm going to do that is because this problem is asking for the ending inventory balance and the total cost of goods sold for the period. And so if I'll just create kind of a general ledger T account format here, it will allow me to keep track of all the inflows and outflows of inventory and the accumulation of total cost of goods sold. So this is just kind of a tool for me to see what's happening in terms of inventory inflows and outflows, and then to calculate an ending balance, which is what this problem is really asking for. And what I'm going to do is I'm just going to account for these individual transactions on a perpetual basis in terms of their effect on inventory and cost of goods sold. For example, the beginning balance given to us in this problem on May 1st says 1,000 cases, and the cost of those at the beginning of the period, apparently we must have just bought them, or this is the cost left over from the prior month. The cost per case is $20. Or we have $20,000 of total inventory in terms of units and cost. The very first transaction, and again I'm going to keep track of this perpetually, showing the increases and decreases, increases debits and decreases in inventory through sales as credits, is on March the 5th. We have or buy 300 additional cases, and apparently there's a little inflation because it costs us $21 instead of what was previously $20 of beginning inventory cost. The total amount of this inventory purchase was $6,300. And by the way, if somebody asked us, what is the balance of your inventory at that point in time, I'd say I have 1,300 cases at a total cost of $26,300. The next transaction, accounting for them perpetually, provided in this example, is that we sell 400 units. Now, when we sell these 400 units, we do need to reflect the outflow of inventory, 400 units, and the cost of those goods sold, but we must determine what are the costs of these inventory units sold. Are they the cost of $20 of beginning inventory, or are these some of the units that we just purchased most recently at $21 per case? Under first in, first out, these 400 cases must be coming out of the first inventory that we have, which was the beginning balance. If in fact these 400 cases that are sold are coming out of the first inventory, there are now 600 units left over that cost us $20 a case. The credit to inventory is for 400 units and their cost using first in, first out costs of $20 are $20 per case, or a total of $8,000 credited to inventory. Anytime we credit inventory as we sell inventory, we also debit cost of goods sold. So I'm going to keep a perpetual running record not only of the inventory inflows and outflows, but when I have inventory outflow, I'll keep perpetually a record of the accumulation of cost of goods sold. That's just a natural byproduct of accounting for inventory perpetually, as I'm also going to be perpetually accounting for cost of goods sold. Now, the next transaction is on March 13th. In this particular case, we buy 400 more cases, $22 a case. The total purchase was $8,800. And theoretically, if somebody said, what is the balance of your inventory at this point in time? I could do that by simply adding the debits less the previous credit of $8,000 to get a total running balance. The next transaction is a sale of 500 units. I know I'm going to have to credit inventory for 500 units and debit cost of goods sold, but what is the cost allocated to these goods sold? Again, under first in, first out, what are the first units that are still in our inventory? Well, it's that beginning inventory still has 600 units left over. So if I now sell 500 units, I must be taking them out of the first inventory. At least I'm assuming that under this cost flow assumption of FIFO. And therefore, I no longer have 600 units left. I only have 100 units left because I'm assuming 500 of those are sold. And therefore, the determination of cost of the goods sold and the total credit to inventory arising therefrom are 500 units at that first cost of $20, or a total of $10,000 credit to inventory and associated debit to cost of goods sold. The next transaction, again on a running basis, is an additional purchase of 600 cases. In this case, $23. The next purchase of 600 cases is at $23, or a total of $13,800 of inventory and its cost. The next transaction is the sale. In this particular sale on March the 29th, we're selling 500 units. How do I determine the cost of the goods sold, or 500 units sold, to properly record this credit to inventory? Again, we're using first in, first out, so I have to go to the first ones in. The first ones in, there's only 100 units left in that beginning inventory at $20. So of the 500 units sold, 100 will be the units at 20. Then the next one down, since those are all gone, I'll go to the next first one, which was the first purchase at 300 units at $21. So theoretically, I've sold 100 at 20, 300 at 21, and then that's all gone. But the sale was for 500 units, and I've only accounted for 400. So I'm actually kind of working my way down such that on the March 13th purchase, 100 of those units are assumed to have been sold, and therefore there are 300 of those units left over. If I'm going to do the total amount of cost of goods sold for these 500 units, I have 100 out of the beginning inventory at a cost of 20, 300 at the next purchase price of 21, and then 100 at the next purchase price of 22. When added together, it's $10,500 is the credit to inventory and debit to cost of goods sold. Finally, this problem asks for the ending balance of inventory. If I'll simply take all of the debits, the beginning balance plus purchases, and subtract all the credits for goods sold, then I will end up with the balance, in this case $20,400. I have 300 of these units purchased on March 13th left over at $22, and 600 units at $23 left over, and added that all up and come to the same conclusion of $20,400. In terms of total cost of goods sold, I'll just add all the debits to cost of goods sold and get $28,500. The next part of this particular example here is use the same information, but to simply apply, instead of a FIFO assumption, we'll assume that the flow of inventory is LIFO. And you can pick any method that you want as long as you use it consistently. Well, again, I'm going to, in my approach to this problem, just again set up the same general ledger T accounts for inventory and cost of goods sold. I'm trying to keep track of them. And there's one other step that can be simplified here. I can go ahead and insert all of the debits to inventory, the beginning balance plus purchases. Because whether I'm using FIFO or LIFO, every time I buy inventory, the method, whether I'm using FIFO or LIFO, doesn't affect, my purchase price. In each case, I bought so many units and I paid so much of a price. 1,000 units at $20 or 20,000 of beginning inventory. Then on March 5th, I bought 300 units at 21. And on March 13th, I bought 400 units at 22. I mean, whether I'm using FIFO or LIFO doesn't change the fact that I bought these units and this is the cost or price that I paid. The only thing that FIFO and LIFO affects is the right-hand side of inventory and the debit to cost of goods sold. See, FIFO and LIFO are inventory cost flow assumptions as to the cost of goods sold, not the inflow of costs, but how we're allocating the costs to the units sold or those still left in our inventory. And so really, I guess I could simplify this a little bit by just writing down all of the beginning inventory and purchases, because really the difference between FIFO and LIFO is just on the right-hand side, or accounting for allocating the cost to the units sold. So I'm going to basically do that here. I'm going to come now, after having filled in all of my debits for beginning inventory and purchases, I'm just going to walk over here to the points of sale. You'll remember that the first sale was for 400 units. But under a LIFO method, instead of going to the beginning inventory or first cost, under LIFO I use a last cost. Well, the last cost was the most recent purchase on March the 5th. So theoretically, I'm going to use for 400 units sold, all 300 of these, theoretically, that were purchased at $21, are going to be included as those units that were sold. And if I sold 400 units, then I must have sold an additional 100 units coming out of that beginning inventory, leaving me with 900 units left over at this point in time. So under a LIFO basis, I would show a cost of 300 units at $21, and 100 units coming out of the beginning inventory at $20 a unit, or cases. The total being 8,300. Credit inventory, debit cost of goods sold. Again, I know I had the next purchase at $22 a unit, 400 units. But again, FIFO, LIFO, the distinction is on the sale of the units. On the sale on March 19th, we sold 500 units. Again, I'm going to approach this on last in, first out. Well, the last ones in were the purchase most recently on March 13th. We bought 400 units at 22, so I'm assuming that all of these are now sold. We're taking the last ones as the first ones out at this point in time. So we'll have none of these left over. We'll assume all of those were sold and their cost was $22. Working backwards, the most recent one previous to that was the March 5th, but all of those have been assumed to have previously been sold. So the last 500 units must again have come out of this beginning inventory, leaving me with 800 units still left there in beginning inventory. So again, what is the credit to inventory for this particular sale? It's 400 units at $22 and 100 units out of the beginning inventory at $20. And the only inventory that I have at this point in time are those 800 units left over there in beginning inventory. So now let's look at the sale of 500 units on March 29th. Again, last in, first out assumes that those 500 units came from the last ones that came in, or the most recent purchase, which was on March 23rd. So we're saying of the 600 units purchased at $23 a unit, that we must have sold 500 of those, leaving 100 units there still unsold. 500 units at $23 is 11,500 units at total cost of inventory sold, credit inventory, and debit cost of goods sold. And again, this problem asks for the ending inventory balance and the total cost of goods sold, and so we'd simply add all the debits of beginning inventory plus purchases minus the credits to inventory on the right-hand side of this T account, which represented costs assigned on a LIFO basis, leaving us with a balance of $18,300. The debit to cost of goods sold would have been simply adding all of the debits for each of the three sales for $30,600. I suppose you could have figured the ending inventory balance of $18,300 another way by recognizing that at this point in time we have 100 units left at $23 a unit, and we have 800 of these units that were there in beginning inventory left at $20 a unit, and added those together and come up with the same amount of $18,300. Well, let's do the last approach here. Again, we've done FIFO and we've done LIFO as an approach. The last one is a weighted average, but under a perpetual inventory method. The weighted average actually becomes a moving weighted average, and I'll show you what I mean by that. Let's go ahead and approach this, and again, I'm going to use the same basic format here, by setting up a general ledger T account for both inventory and cost of goods sold, and then kind of work through it perpetually. One of the things that you'll notice is that I am going to show the beginning inventory in all purchases the same as I have in the other problems. Because which method I'm using to account for the allocation of costs of goods sold does not affect the actual price purchased for inventory during the period. But what I am going to do here is that I'm periodically going to have to calculate some kind of an average cost previous to any sale of goods. Because when I sell any inventory, I want to apply what represents an average of all the inventory that we own or possess up to that point in time. And so let's go ahead and take a look at this. Again, we had a beginning inventory of 1,000 units at $20 or $20,000 total cost. Our first purchase on March 5th with 300 units at $21 a unit. Now, some people may say there that the average cost of our inventory purchases is $20.50. Some were bought at $20 and some were bought at $21. The average would be $20.50. But that is not a weighted average. You see, we have a lot more inventory and beginning inventory at $20 cost. A weighted average that accounts for the fact that we have more inventory at another cost or differing cost requires that we really add the total cost of our beginning inventory plus the purchase, or a total of $26,300, and divide it by the total number of units. In this case, 1,300 units. That gives us a weighted average of $20.23 as of that point in time. It's a weighted average. It'd be $20.50. It was just a plain average. Now, we sold, our next transaction was a sale of 400 cases. What cost are we going to apply? Well, we're going to use this weighted average. And at this moment, the average cost of our inventory up to that point in time, the 1,300 units we have on hand, is $20.23. So 400 units at that average cost would give me $8,092 credit inventory, debit cost of goods sold. Now, the next transaction that we have is not a sale, but a purchase. If we sold more units, we'd just use that same average of $20.23. But instead, we have a purchase of 400 units at $22. This is going to affect our average. And in fact, if it's going to be a weighted average, we're going to have to account for the fact that we've only got 400 units at $22, $8,800 of cost. We're adding that to the fact that we had 900 units left over after that first sale. We had 1,300 units before we sold 400 units, so we have 900 units that had an average cost of $20.23. If we add our total inventory units at this point in time, the inventory left over previous to that first sale of 900 units at $20.23 and 400 units purchased at $22, and get the new total cost of $27,007, and the fact that we now have, again, 1,300 units, a new moving weighted average would be to take the $27,007 divided by 1,300, or $20.77, represents a new average cost that is a moving average because it's accounting for all of the previous transactions up to this point in time. $20.77 is our new moving weighted average of the 1,300 units available at this point in time. If we now sell 500 units as we do on March 19th, those 500 units should be costed at $20.77 per unit, or $10,385. Credit inventory, debit cost of goods sold. Now, continuing on with this particular problem, our next transaction is the purchase of some additional inventory, again at a different and higher cost. Again, if we're going to calculate a moving weighted average, what we're going to need to do is add that on in terms of our cost of inventory at that point in time and calculate a new weighted average. We have 800 units left over after the last sale. Remember, we had 1,300 units and we sold 500. So we have 800 units left over after the last sale, and the cost of those units had been calculated at an average of $20.77. If we now buy an additional 600 units at $23 per case, we're adding an additional cost of $13,800 for a total cost of $30,416, given that we now have 1,400 units. We can calculate a new moving weighted average by taking the total cost divided by the number of units. In this case, $21.73 is a weighted average that's moving as we move through these inventory transactions perpetually. Again, our next sale is 500 units. Those 500 units are coming out of the 1,400 that have an average cost of $21.73. So those 500 units will be costed at $21.73. Credit inventory, debit cost of goods sold. And then finally, the ending balance of inventory and cost of goods sold is simply taken by adding all of the debits, beginning balance and purchases, less the credits for cost of goods sold or the inventory being sold, to give us the ending balance. I suppose another way to come to that calculation, and there may be some rounding errors as we made these calculations and rounded each average to the nearest hundredth. In this particular case, I suppose you could take 900 units, because if we had 1,400 units and sold 500, we'd have 900 units left over. And the average cost at that point in time should be 900 units at $21.73, which should equal that amount or be very close to it, given the effect of rounding errors. Again, cost of goods sold is simply adding all of the debits to cost of goods sold for the 3 sales transactions.